Hello everyone and welcome to this short video in which we will be discussing example 3, which is part of the EPS or earnings per share series. If you have not downloaded example 3, please go onto your Blackboard page under the EPS or earnings per share section and download class example 3. We will only be looking at part A. Part B is disclosure. So it's very similar to what we're doing in part A, and it's just a reorganization of the information. So for now, we'll only be doing part A. What is important is that if you don't have a copy of this example for yourself to look at, this video is going to be very difficult for you to watch. So I suggest that maybe you just go and download the example now, stop the video, go download the example, and then come back and we can go through it together. Okay, so if we have a look at the information, the first part of the information reads, the following information concerns the issued share capital and earnings for a company for the year ended 31 December. So we know the year end is 31 December. We also know that the information that we're going to look at is going to be somewhat rands, right? Because it says earnings there. So there's going to be rands, but there's also going to be amounts that are not rands. They are number of shares. So we want to just have a look at that and remember that while we're reading. So it says the number of ordinary shares at the beginning of the year. So if it's telling us at the beginning of the year, it's actually indicating the opening balance. Now we can see the opening balance in 2013 is 5,000 shares, as well as the opening balance in 2012 is 5,000 shares, which means that there hasn't been a movement or an issue, either for value or no value shares in ordinary shares. So what that means is that our basic earnings per share is going to be very easy to calculate. We expected that because this question is actually a question that relates to diluted earnings per share. So when we look at the next piece of information, it says the number of cumulative preference dividends at the beginning. So again, it's giving us the opening balance at the beginning of the year. And it says 800 for both years. So there hasn't been any change. There's no movements. Notice it's cumulative. That means we always need to take it into account, regardless of whether it's been paid or declared. And we always only take into account the current year. We don't take into account arrears. Okay, so we need to keep that at the back of our mind. Now it says that in the brackets, it says a fixed annual dividend of 50 cents per share. So what would that look like? What amount is that going to look like? So we've got 800 shares, right? And we want to multiply those 800 shares by 50 cents. We're going to get an amount of preference share dividend. Remember, it's cumulative preference share dividends of 400 Rand per year, both 2013 and 2012. So in the current year and the prior year. Okay, so that is going to be our calculation. That's how much we're paying for preference share dividends. Then it says the number of 12% convertible debentures issued at 2 Rand 50 on the 1st of January 2013. Now, when is the 1st of January 2013? Well, that's the first day of the current year. Remember, we look at 2013 and 2012. That's the first day of the current year. Okay, so because it's coming on the first day of the current year, is there a need to weight it? Well, no, there isn't, because the capital that relates to that specific amount was available for the entire year. So we wouldn't need to weight it under diluted earnings per share. It then says the debentures are convertible into 1,000 ordinary shares on 30 June 2015 at 4 Rand each. Okay, so it tells us that they have an option to buy 1,000 ordinary shares. But because 2015 is outside of our year of consideration, we're only looking at 2013 and 2012. So 2015 is outside of that. we wouldn't really pay too much attention to that now. But in example 4, which we're going to look at in class, we're going to have to pay very careful attention to that, because that specific conversion date is going to happen in the year. Remember, when we have shares that are issued or converted, convertible instruments these are. So when we have convertible instruments that are issued or converted in the current year or the prior year under review, then we have to weight it for the part of the year that it was either in issue or converted. Because when we're dealing with dilutive shares, we only want it to be dilutive for that period between issue and conversion. So it says that the interest on the convertible shares have not yet been calculated. I'm sure we can calculate that. Let's try. So we're going to say we have 2,000 shares, right? We want to multiply those 2,000 shares by 2 Rand 50, right? So 2 Rand 50, that's going to give us the basically value of the shares. And after that, we want to multiply that amount by 12. Okay, so if you pop that in your calculator, what exactly do you get? I'll give you some time. We get an amount of 600 Rand. So the interest on the convertible debentures is 600 Rand. Okay, so we can just move that up there, put that there. Okay, and then it tells us that the profit for the year, remember, we like profit for the year because it's after tax and we only want to deal with an after tax amount, is 5,300 and 4,800. And then it gives us the tax rate. Why are they giving us the tax rate when they've already taken it into account in the profit? Well, they're expecting us to use it when we are looking at interest. Remember, when we are diluting the shares, we must add back the interest to earnings because we're no more going to be paying it, right? And we can only add back the after-tax effect because we are also no more going to be able to claim that interest as an expense. Okay, cool. Let's look at page 2. Now, I'm going to change, in fact, page 3. So I'm going to change to page 3, and if you can do the same on your side, that would be good as well. So look at our calculation. So we started off with our 5,300 and our 4,800. We reduced it by our dividends that we calculated. Remember, we calculated that dividends while we are still reading the question. We knew, so now I've changed back to the original slide and we'll see an amount there of 400 Rand that we had calculated. So that is the 400 Rand dividends that is being subtracted from earnings. Why are we subtracting the cumulative dividends? Number one, we subtract cumulative dividends regardless of whether it is being paid or declared. We always subtract it. We only subtract the current year amount, not the arrears. In addition, we subtract it from profit because it's not being owned. It's not attributable to our ordinary shareholders. It belongs to our preference shareholders. So that's why we reduce it. When we reduce it, we get an amount for earnings, right? So that's the basic earnings amount. So 4,900 in 2013 and 4,400 in 2012. Okay, now we know that the convertible debentures were issued on the first day of 2013. Therefore, we don't need to weight it. We still need to calculate the interest though, because the convertible debentures are going to have a dilutive effect on our basic earnings per share. This is what we're doing when we're trying to calculate diluted earnings, right? So we started off with 2,000 shares. We multiplied it by our 2.5 Rand. We got 5,000, right? And we multiplied it by 12. Why did we not apportion it for part of the year? Because it was an issue for the entire year. So that's the 12 over 12 means that we had it, it was an issue for 12 months of the 12-month year. And then they multiplied it by 72, which is 72 is the after-tax effect. Remember, the tax is 28%. So if you take out the tax, you're going to be left with 72%. So that's why they've multiplied it by 72%, and we get an amount of 432 Rand. Okay, we get an amount of 432 Rand, which is basically the after-tax effect of the 600 Rand. That amount is added back. Why are we adding it back? Because now we're saving. We're not paying the interest because we're assuming that these dividends have been converted, right? Because the dividends have been converted, we are no more needing to pay this interest to the holders of the sorry, not the dividends, the debentures. Because the debentures have been converted into ordinary shares, we are no more having to pay the interest on these debentures because they are now ordinary shares. They're not debentures. So the debenture holders aren't entitled to the interest that relates to those debentures. So if we look at the WANOS calculation, there were no issues in the current year, either for value or not for value. So we started off with 5,000 shares at the beginning of the year, and we ended with 5,000 shares under basic, right? In both cases, so in both the current year as well as the prior year, that was the case. We ended with 5,000. So the basic WANOS is pretty easy to calculate. Then we have the potential ordinary shares. Those are the convertible debentures. Remember, they said they can convert into 1,000 ordinary shares in 2015. So that is why we've put 1,000 here under the current year. It's not under the prior year. So if you have a look at the prior year where the dots are appearing, you're going to see a big 0 there. And that is because they were only issued on 1st January 2013. So they were issued after 2012 financial year. So they weren't in existence 2012 financial year. Another thing is that these shares were conveniently issued at the beginning of the year. What would have happened if they were issued through the year or sometime in the year? We would have had to weight them. So for example, now I'm going to change the question and we're going to say, let's assume that these shares were actually issued halfway through the year, so 6 months in. We're going to take 1,000. Why 1,000 and not 2,000? Well, we're going to take 1,000 because that is the total number of ordinary shares that could come out of this convertible debenture. So we're not taking the actual amount of convertible debentures. Instead, we're looking at the ordinary shares that could result from these convertible debentures. And that's 1,000 Rand. And if they were issued halfway through the year, so 6 months into the year, we'd times it by 6 and divide it by 12, and we'd get an amount of 500 shares, or a number of 500 shares. So that would have been the case if the shares were issued halfway through the year. We would have weighted them for the period of time that they were in issue. Does that make sense? So we weighted them for the period of time that they were in issue. So if, for example, they were only issued on the 1st of October, right? Then they would have only been in issue for 3 months, October, November, December. So 3 months. We would have then said 3 divided by 12. Okay. So that is how we come up with this amount. So after we did that, we look at what the basic earnings per share now looks like. Again, they've just simply copied that those specific calculations. And if you look here, they've just copied it across and they've divided it. Now have a look at that dilutive effect. It's gone from 0.98 to 0.88 from 1 year to the next. Sorry, this is not a dilutive effect. This is a change from 1 year to the next within basic. But the dilutive effect is when we look at these numbers like that. So if we look at those numbers across, it was 0.98 and now it's become 0.89. That's a dilutive effect. In the prior year, there doesn't seem to have been a dilutive effect. It was anti-dilutive. Okay, so it was 0.88 and it stayed at 0.88. So it was not dilutive in the prior year. Okay, so that is what it looks like. So in part B, we're not going to go through part B in detail, but again, it's just the reallocation and they were putting the numbers into the correct place. So all of these numbers that we're finding here are actually from the calculations that we've already done, and they're just putting it neatly and then presenting it on the income statement. Okay, guys, thank you for watching this short video on example 3. I would encourage you to do the example again on your own, as well as the other examples that are on your Blackboard page. But in the meantime, all the best, and I will see you in the next video.